Hi everybody and welcome to the first T4Trade podcast. My name is Andreas and I'm the market analyst at T4Trade, and in our first podcast we will go over the key concepts of fundamental analysis. In a nutshell, fundamental analysis is the study of economic and political forces that determine the currency's exchange rates. A currency exchange rate is the price of one currency in terms of another currency. By bundling together two currencies, an FX rate is created, and every pair has a price. Now, like any other price, currency exchange rates, or FX rates if you prefer, are driven by supply and demand forces. This is where the role of fundamental analysis comes into play, whose main goal is to forecast how these forces will impact currency exchange rates and subsequently attempt to forecast how the exchange rates will move as a result. Drawing from economics, when demand for a good or service increases, it usually causes its underlying price to appreciate as a consequence. The inverse is also true, meaning that when demand for a specific good or service decreases, it usually causes its price to decline as a result. When it comes to the supply side, the greater supply for a good or service usually leads to a lower price and vice versa. Therefore, demand has a direct or positive relationship with prices of a certain good or service, while the supply has a negative or inverse relationship with its underlying price. Practically, the mechanics behind it indicate that greater supply tends to ease demand since it satisfies more consumers' needs. Now, as an example, imagine that we all want the new Mercedes model, but it's a limited edition and only 500 will be manufactured. The price of the car will most probably be high since demand is greater than the supply. Since it's a limited edition, loads of people will be chasing after the car, but unfortunately not all will get their hands on it. However, let's say that suddenly Mercedes announces that it will produce another 50,000 additional units of this car model. The price will probably decline since more cars will be available in the market and thus demand will be satisfied. Besides supply and demand forces, another factor that greatly affects currency exchange rates are growth rates of countries. Usually, countries that grow at a faster pace are often great places for investment since there are more opportunities for economic expansion, incomes are rising, and thus incentives for consumer spending increases as well. Overseas companies want to set up operation in those countries in order to get a piece of the pie. They're buying companies, building up factories, setting up stores, and foreign investors usually want to buy stocks of companies operating in those countries. All these factors normally tend to boost demand for the currency, which in turn leads to its appreciation. Another key factor that is extensively looked at is the trade balance of countries. In essence, trade balance of a nation is the difference between the total exports and the total imports. Broadly speaking, countries who run persistent trade surpluses tend to have strong currencies, while nations that consistently have trade deficits tend to have weaker currencies. For example, if Japan exports more goods to the US than the US exports to Japan, then demand for Japanese yen from the US increases, and therefore the yen may strengthen against the dollar. Moreover, natural resources of countries also have a material impact on their respective currencies. Normally, countries with rich natural resources tend to earn foreign exchange by exporting those resources. Hence, in the scenario where the price of natural resources exported by a country appreciates, the value of the total export goes up as well, and therefore the currency may appreciate due to the increased demand for the commodity. On the flip side, when the price of exported resources goes down, the currency may depreciate as a result. A classic example in the FX markets is of course the Canadian dollar's relationship with oil, since Canada is one of the major oil producing countries. It's understandable therefore that the value of the Canadian dollar is linked to oil prices, and whenever oil prices are on the rise, it tends to support the Canadian dollar. Other classic examples include the Australian dollar with iron ore and the New Zealand dollar with dairy products. There are other factors, of course, that affect currency's price, such as the fiscal and monetary policy, and that is to be discussed in the next episode. Thanks for listening. Stay tuned.